Legal disclaimer. The content presented in this video series, including all spoken narration, visual aids and accompanying text, is strictly for educational, informational, and entertainment purposes only. It does not, under any circumstances, constitute professional financial, investment, tax, or legal advice. Foreign exchange trading, commonly known as Forex, carries a high level of risk and may not be suitable for all investors. The high degree of leverage often available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance of any trading system, methodology, or market outlook is not necessarily indicative of future results. Any case studies, examples, or hypothetical trading scenarios discussed are for illustrative purposes only and do not guarantee that you will achieve similar results. By continuing to watch this video, you acknowledge that you are solely responsible for your own due diligence and financial decisions. Imagine a river. But this isn't a river made of water. It is a river made of pure purchasing power, flowing silently beneath the floorboards of the global economy, 24 hours a day, 5 days a week. Every single second, billions of dollars change hands. While the New York Stock Exchange, the symbol of American financial might, trades approximately $22 billion a day, this invisible river dwarfs it entirely. We are talking about a market that moves over $6.6 trillion every single day. To put that number into a perspective that the human brain can actually comprehend, that is significantly more than the entire annual gross domestic product of Japan, the third largest economy on Earth, traded in a single 24-hour cycle. This is the foreign exchange market. It is the largest, most liquid, and most ruthless financial battleground in human history. Here is the controversial truth that most online gurus and course sellers will never tell you because it hurts their bottom line. Statistically speaking, the odds are stacked overwhelmingly against you. There is a concept in this industry often whispered by risk managers at major institutions, known as the 90-90-90 rule. It suggests that 90% of new retail traders will lose 90% of their starting capital within their first 90 days of active trading. Why does this happen? Is it because the market is rigged? Is it because the banks are hunting your specific stop loss? Or is it simply because the average individual steps into the arena with a professional athlete's ambition but a toddler's understanding of the rules? Most people view Forex as a slot machine where you press a button and money pours out. They see the flashing lights of a chart, the green and red candles, and they mistake volatility for opportunity. But without the right map, volatility is not opportunity. It is a guarantee of destruction. You are here because you have seen the lifestyle marketing. You have seen the laptops on the beach, the rented supercars, and the promises of financial freedom attained in minutes a day. But you are also here because deep down you suspect that there is more to the story. You are right. There is a massive chasm between the retail trader, that is you, trading from your computer or phone, and the institutional trader working for Goldman Sachs, JP Morgan, or Deutsche Bank. The institutional trader is not guessing. They are not gambling. They are executing mathematical models based on macroeconomic data, geopolitical shifts, and central bank policies. They are the sharks in the water. Up until this moment, without proper education, you have been the bait. This creates an urgent problem for you right now. We are living in an era of unprecedented economic uncertainty. Inflation is eroding the purchasing power of your savings account at a rate we have not seen in decades. The money you hold in the bank is slowly dying, losing its ability to buy goods and services year after year. Understanding how currencies move, why the US dollar strengthens against the euro, or why the Japanese yen weakens against the British pound, is no longer just a niche skill for Wall Street elites. It is becoming a necessary survival skill for anyone who wants to protect and potentially grow their wealth in a globalized economy. If you do not understand how money moves, you are at the mercy of those who do. The problem is that the barrier to entry is low. Anyone can download an app and fund an account with $50. But the barrier to competence is incredibly high. The internet is flooded with fragmented information, contradictory strategies, and dangerous advice that encourages gambling rather than trading. This brings us to the promise of this deep dive masterclass series. Over the next 10 comprehensive videos, we are going to systematically dismantle the complexity of the foreign exchange market. We are not going to sell you a signal service. We are not going to promise you overnight riches because that does not exist. Instead, we are going to do something far more valuable. We are going to build your foundation from the bedrock up. We are going to transform you from a gambler into a risk manager. This series is designed to solve the black box problem. For most beginners, Forex is a black box. Data goes in and random results come out. We are going to tear that box open. We will explain exactly what a currency pair is and why they wrestle for dominance. We will demystify the cryptic language of the industry, pips, lots, leverage, margin, spread, and swaps, so that when you look at a trading terminal, you don't see confusion, you see clarity. We are going to dive deep into the two pillars of analysis: fundamental analysis, which looks at the economic health of nations, and technical analysis, which interprets the psychology of the market through price action and charts. But we will go further than just definitions. We are going to explore the psychology of money. Trading is perhaps the most psychologically demanding endeavor you can undertake, because it forces you to confront your own relationship with greed and fear. We will discuss why your brain is biologically wired to fail at trading, why you feel the urge to hold on to losing trades hoping they will turn around, and why you feel the panic to close winning trades too early just to secure a small profit. This biological wiring is exactly what the institutional algorithms are designed to exploit. By understanding these cognitive biases, you can learn to override them. We will also tackle the mechanics of the brokerage industry. Not all brokers are your friends. We will explain the difference between A-book and B-book brokers, how spreads can eat your profits alive if you aren't careful, and how to conduct due diligence to ensure your funds are safe. This is the unglamorous side of trading that nobody talks about, but it is the difference between longevity and bankruptcy. By the end of this 10-part masterclass, you will not just know about Forex. You will understand the ecosystem. You will look at a chart and understand that it is not just a squiggly line, but a visual representation of human emotion and global capital flow. You will understand that when the Federal Reserve raises interest rates in the United States, it sends a shockwave that is felt from Tokyo to London, and you will know how to interpret that shockwave. You will possess the knowledge to approach the market with respect, caution, and a strategy based on probability rather than hope. This journey requires patience. It requires you to abandon the lottery ticket mindset. If you are looking for a way to double your money by next Friday, you should close this video right now. This is not for you. But if you are ready to treat this like a profession, if you are willing to study the mechanics of the global financial machine, and if you want to understand the language of money that dictates the flow of the world economy, then you are in the right place. We are about to embark on a journey into the heart of the largest market on the planet. We are going to pull back the curtain on the $6.6 trillion daily volume. We are going to arm you with the tools, the terminology, and the tactical awareness to survive the river. The water is deep, the current is strong, and the sharks are always hungry. But with the right knowledge, you can learn to navigate it. Let's begin. To understand the mechanics of this $6.6 trillion river, we must first strip away the complex terminology that gatekeepers use to keep you out. At its core, the foreign exchange market is the marketplace of nations. Unlike the New York Stock Exchange, which has a physical building on Wall Street with a bell that rings at 9:30 a.m., the Forex market has no central location. It is decentralized. It is a ghost network. It exists entirely on servers connecting central banks, commercial banks, hedge funds, and retail brokers across the globe. It is an over-the-counter market, or OTC, meaning the transaction happens directly between two parties via a computer network rather than on a centralized exchange floor. Think of it like this. When you buy a stock, say a share of Apple, you are buying a tiny piece of ownership in that specific company. If the company sells more iPhones, the stock price theoretically goes up. You are betting on the performance of a corporation. In Forex, you are not betting on a company. You are betting on a country. When you buy the US dollar, you are essentially buying a share in the American economy. You are betting that the United States economy, its GDP, its manufacturing data, its employment numbers, and its political stability will outperform the economy of another country. You are acting as a macroeconomic speculator. But here is the twist that trips up almost every beginner. In the stock market, you can just buy Apple. You trade your cash for the stock. In Forex, money is the product. You cannot just buy a dollar. You have to pay for it with something else. You have to sell another currency to acquire it. This is why currencies are always, without exception, traded in pairs. You will never see a quote for just euro or just USD. You will always see euro to US dollar, pound sterling to Japanese yen, or US dollar to Canadian dollar. Visualizing this relationship is critical for your survival in the market. Imagine a tug-of-war or a teeter-totter. On one side, you have the euro representing the Eurozone economy. On the other side, you have the US dollar, representing the American economy. The exchange rate is the balance point of that teeter-totter. If the Eurozone releases fantastic economic data and the US releases terrible data, the euro gets heavier or stronger, and the teeter-totter tips in its favor. The chart goes up. If the US economy strengthens while Europe struggles, the dollar pulls the teeter-totter down. The chart goes down. Every single movement you see on a screen, every tick of a red or green candle, is simply that struggle for dominance playing out in real time between two nations. Let's ground this in a real-world case study that you have likely experienced without realizing you were trading Forex. Imagine you are an American citizen planning a dream vacation to Italy. You have $1,000 in your pocket. You cannot spend US dollars in Rome, you need euros. So you walk up to a currency exchange kiosk at JFK International Airport. You look at the digital board and it displays a rate for euro to US dollar. Let's say the rate is 1.10. This number 1.10 is the price. It tells you exactly how many US dollars it takes to buy one single euro. In this scenario, you have to pay $1.10 to get 1 euro. You hand over your $1,000. The clerk does the math and hands you back approximately 909 euros. You have just executed a Forex trade. You sold dollars and you bought euros. Now, here is the imagine if scenario that explains how traders actually make money. Imagine you fly to Italy, but once you land, you decide not to spend a single penny. You keep those 909 euros tucked safely in your wallet. You stay for a week, enjoy the sights, and eat free food at a friend's house. During that week, something major happens in the global economy. Maybe the European Central Bank announces they are raising interest rates, making the euro more attractive to investors. Or maybe there is a political scandal in the United States that causes investors to lose faith in the dollar. Because of these events, the value of the euro rises against the dollar. The teeter-totter shifts. When you return to the airport to fly home, the exchange rate board has changed. It no longer says 1.10, it now says 1.20. This means 1 euro is now worth $1.20. It has become more expensive. You walk up to the kiosk to swap your money back. You hand over your same 909 euros. But this time the clerk uses the new rate. They multiply your 909 euros by 1.20. The calculator shows a result of roughly $1,090. You hand them the euros and they hand you back $1,090. Pause and analyze what just happened. You started with $1,000. You ended with $1,090. You made a $90 profit, or a 9% return on your capital, simply by holding the right currency while the exchange rates fluctuated. You created wealth out of thin air because the relative value of the two economies shifted. This is the mechanism of Forex trading. But here is the reality check. Professional traders do not fly to Rome to make a trade. They do not pay the exorbitant fees at airport kiosks. And they certainly do not wait weeks for a 10% move because in the world of major currencies, a 10% move is a massive, rare event that might take months or years to happen. Major currencies usually move in fractions of a penny per day. So, how do we trade this digitally? We use what are called tickers. The 3-letter codes you see are determined by the International Organization for Standardization. The first 2 letters usually identify the country, and the 3rd letter identifies the currency. USD is United States dollar. JPY is Japanese yen. GBP is Great British pound. CAD is Canadian dollar. NZD is New Zealand dollar. CHF is the Swiss franc. This one is tricky. C stands for Confederatio Helvetica, the Latin name for Switzerland, and F stands for franc. In this ecosystem, we categorize these pairs into 3 distinct baskets based on their liquidity. Liquidity simply refers to how much money is flowing through them, like water in a pipe. First, you have the majors. These are the heavyweights, the titans. These pairs almost always include the US dollar on one side.
Euro, USD, USD, Yen, GBP, USD, USD, CHF.
These pairs account for the vast majority of all daily trading volume. Because so many people trade them, they are usually the cheapest to trade and the most stable. The movements are smoother. If you are a beginner, you should live here. This is the shallow end of the pool where the lifeguards are watching. Second, you have the minors, sometimes called the crosses. These are major currencies traded against each other. but without the US dollar involved. Examples include euro to pound sterling, euro versus pound, or Australian dollar to Japanese yen, Australian dollar versus Japanese yen. These can be slightly more volatile. The water is a bit choppier here. Trends can be messier because you are removing the stabilizing force of the world's reserve currency, the US dollar. Third, you have the exotics. This is where the danger lies. Exotics involve a major currency paired with the currency of a developing or emerging economy. Examples include US dollar to Mexican peso, US dollar versus Mexican peso, or USD/TRY US dollar versus Turkish lira, or USD/AR, US dollar versus South African rand. These pairs are the Wild West. The liquidity is low, meaning there aren't as many buyers and sellers. Because the liquidity is low, the price can move aggressively and unpredictably. A political announcement in Turkey can send the lira crashing 20% in a single afternoon. While the potential for massive movement exists, the cost to trade them is high, and the risk of getting wiped out is extreme. Beginners often get lured into exotics because they see huge movements, but they rarely survive the volatility. Now, you might be looking at the math we did earlier and spotting a flaw in the plan. In our airport example, the price moved from 1.10 to 1.20. That is a massive move. In reality, the euro might move from 1.1000 to 1.1050 in a single day. That is a fraction of a penny. If you trade $1,000 and the market moves a fraction of a penny, you might make 50 cents. You are not going to achieve financial freedom making 50 cents a day. You would need millions of dollars in your account to make a livable income from these tiny movements. This is the barrier that kept retail traders out for decades. It was a rich man's game. If you didn't have $1 million to put on the table, you couldn't play. But then the industry invented a tool that acts like a magnifying glass for your money. A tool that allows a regular person with $500 to control a position worth $50,000. It is the most powerful weapon in a trader's arsenal, and also the primary reason those 90% of traders fail. It is called leverage. And understanding how to use it without blowing off your own foot is the only thing standing between you and the poorhouse. To understand how we turn pennies into paychecks, we need to enter the engine room of the broker. Leverage is the financial equivalent of a supercharger on an engine. Without it, the vehicle moves, but it moves slowly, predictably, and safely. With it, you can go from 0 to 60 in seconds, but if you lose control for even a fraction of a moment, the crash is fatal. To truly grasp this concept, we have to step outside of the trading terminal for a moment and look at the real estate market, because you likely already understand leverage, you just know it by a different name, a mortgage. Imagine you want to buy a house as an investment. The house costs $100,000. You do not have $100,000 in cash lying around. You have $10,000. You go to the bank and you put down your $10,000 as a down payment. The bank lends you the remaining $90,000. You now control an asset worth $100,000, even though you only invested $10,000. This is leverage. You are leveraged 10 to 1. Now imagine the real estate market heats up. The value of that house rises by 10%. The house is now worth $110,000. You decide to sell. You pay back the bank their $90,000. You keep your original $10,000 deposit. That leaves you with $10,000 in clear profit. Stop and look at the math. The asset, the house, only increased by 10%. But your return on investment was not 10%. You started with $10,000 and you made $10,000. Your return was 100%. You doubled your money on a 10% move. That is the magic of leverage. It magnifies your purchasing power. In the Forex market, we do the exact same thing but on steroids. Brokers offer leverage ratios that would make a mortgage lender faint. It is common to see leverage of 150, 1:100, or in some unregulated offshore jurisdictions, a staggering 1:500. Let's break down exactly how this works with your money. Suppose you deposit $1,000 into a brokerage account. You want to trade the euro to US dollar pair. If your broker gives you 1:100 leverage, it means for every $1 of your own money, the broker allows you to control $100 of position size. With your $1,000 account, you can effectively control $100,000 worth of currency. You are punching 100 times above your weight class. However, the broker isn't just giving you this money out of the kindness of their heart. They require insurance. This insurance is called margin. Margin is not a fee. It is a good faith deposit. It is collateral. When you open a leverage trade, the broker takes a portion of your account balance and locks it aside. They say, you can hold this massive position, but we are freezing this portion of your money to cover any potential losses. If you close the trade, that frozen margin is released back to you. If the trade goes against you, that margin acts as the buffer. So we have the leverage and we have the margin. Now, how do we measure the profit? We cannot simply say the price went up. We need a precise unit of measurement. In the stock market, we use dollars and cents. In Forex, we use pips. PIP stands for percentage in point, or price interest point. For most currency pairs like the euro to US dollar, the pip is the fourth decimal place. If the price of the euro moves from 1.1050 to 1.1051, that is a 1 pip movement. Seems microscopic. It is 1/100th of 1%. In the real world, a 1 pip move is meaningless. You wouldn't bend over to pick up a pip on the sidewalk. But when you apply leverage, that microscopic pip becomes a wrecking ball. To understand the value of a pip, we must introduce the lot. In Forex, you don't just buy some currency. You buy standardized contracts called lots. There are 3 main sizes you need to memorize. First, the standard lot. This is 100,000 units of currency. If you trade one standard lot of euro to US dollar, you are trading 100,000 euros. In this scenario, every single time the price moves just 1 pip, that tiny fourth decimal point, you make or lose $10. Second, the mini lot. This is 10,000 units of currency. It is 1/10 the size of a standard lot. Here, every pip movement is worth approximately $1. Third, the micro lot. This is 1,000 units of currency. Here, every pip movement is worth 10 cents. This is where the math gets exciting and terrifying. Let's go back to our example. You have a $1,000 account. You feel confident. You decide to use your leverage to open one standard lot. You are now trading with $100,000 of buying power. The broker locks up a chunk of your money as margin, perhaps $500, leaving you with $500 of free margin to absorb moves. You press buy. You need the chart to go up. If the price goes up by just 10 pips, a movement that can happen in 30 seconds during a busy market session, you have made 10 pips times $10 per pip. That is $100. You just made a 10% return on your entire account balance in 30 seconds. If the price goes up 50 pips, you have made $500. You just made a 50% return in a single afternoon. You can see why the allure is so strong. You can see why people quit their jobs to do this. But now we must look at the dark side. The side that wipes out accounts. Imagine you open that same standard lot. You are looking for the price to go up. But instead, an unexpected news report comes out. The US inflation data is higher than expected. The dollar spikes. The euro crashes. The price drops. It drops 10 pips. You are down $100. It drops 20 pips. You are down $200. It drops 50 pips. You are down $500. Remember, you only had $1,000 to start, and the broker locked away some of it as margin. As your loss deepens, you eat through your free margin. When your free margin hits 0, you trigger a margin call. This is the nightmare scenario. The broker's computer algorithm looks at your account and says, "This trader is losing money so fast that they are about to lose our money." The broker will not lose their money. They will not let your account go negative. So the instant your equity falls below a certain threshold, the broker automatically closes your trade. They liquidate you. Your position is closed instantly at a loss. You are left with pennies in your account. The market might turn around and go back up 5 minutes later exactly as you predicted, but it doesn't matter. You are already dead. You have been stopped out. This is how a $1,000 account vanishes in minutes. Not because the trader was wrong about the direction in the long run, but because they were over-leveraged and couldn't survive the short-term volatility. They tried to drive the car at 300 miles per hour and hit a pothole. This brings us to the golden rule of survival. Leverage is not a requirement. It is an option. Just because the Ferrari goes 200 miles an hour doesn't mean you drive it that fast in a school zone. Professional traders rarely use the maximum leverage available. They might have access to 1:500, but they effectively use 1:5 or 110. They understand that longevity is more important than a quick windfall. So we have built the machine. You understand the currency pairs, the battle between economies. You understand the broker, the leverage that amplifies your power, and the margin that acts as your collateral. You understand the pip, the atomic unit of price movement. You have the car, you have the fuel, and you know how the pedals work. But you are sitting in a parked car. You are looking through the windshield at the market, represented by the charts. And right now, that chart probably looks like a chaotic mess of red and green bars, squiggly lines, and nonsense. It looks like an electrocardiogram of a giant having a heart attack. How do you read it? How do you know if the next move is up or down? To drive the car, you need to read the road. You need to understand the language of price itself. The chart is not random. It is telling you a story of war between buyers and sellers, localized down to the very minute. To decode this story, we have to master a Japanese invention from the 18th century, originally designed to trade rice, which is now the standard for trading trillions of dollars. We need to learn how to read candlesticks. Shutterstock. Explore. Munehisa Homa. Remember that name. In the 1700s, long before Wall Street had electricity, computers, or even a telegraph, Homa was a rice trader in Osaka, Japan. He didn't just trade rice. He dominated the market so thoroughly that legend says he once had 100 winning trades in a row. He amassed a fortune equivalent to billions of dollars in today's money. How did he do it? He realized that while the supply and demand of rice were important, the emotions of the traders, fear, panic, greed, and anticipation, were the true drivers of price. He developed a visual system to track these emotions. Today, that system is the universal language of financial markets. Japanese candlesticks. When you open a trading chart on your laptop or phone, you are not looking at a simple line graph like you might see in a high school math textbook. A line graph is one-dimensional. It only tells you the closing price. It is a summary that hides the drama. Instead, you are looking at a series of rectangular bars with thin lines sticking out of the top and bottom. These are the candlesticks. To the untrained eye, they look like random blocks. To the professional, every single candlestick is a detailed battle report of a specific period of time. Let's dissect the anatomy of a single candle. It has two main components, the body and the wicks, sometimes called shadows. The wide, colored part in the middle is the body. The thin lines extending from the top and bottom are the wicks. This structure gives us four critical pieces of data, known in the industry as OHLC: open, high, low, and close. The open is the price at the exact second the time period began. If you are looking at a 1-hour chart, and the time is 10 a.m., the open is the price at exactly 10 hours. The close is the price at the exact second the time period ended. At 10 hours 59 minutes and 59 seconds, wherever the price is sitting, that freezes the candle and completes the body. The difference between the open and the close creates the body. If the close is higher than the open, the body is usually colored green or white. This is a bullish candle. It tells you that between 10 a.m. and 11 a.m. the buyers won. The price moved up. If the close is lower than the open, the body is usually colored red or black. This is a bearish candle. It tells you that the sellers won and the price moved down. But the body is only half the story. The wicks are often where the real secrets lie. The top of the upper wick represents the high, the highest price reached at any point during that hour. The bottom of the lower wick represents the low, the lowest price reached during that hour. Why do the wicks matter? Because they represent failure. They represent rejection. Think about it. If you see a candle with a long upper wick, it means that at some point during the hour, buyers pushed the price all the way up to that high point. They were feeling euphoric. They were aggressive. But by the time the hour ended, they couldn't hold that ground. The sellers stepped in, overwhelmed them, and pushed the price back down before the candle closed. That long upper wick is a visual record of the buyer's failure. It is a scar on the chart that screams, "We tried to go higher, but we were rejected." Let's run a real-time simulation to cement this concept. Close your eyes for a second and imagine you are watching a live chart. The time frame is 1 hour. The pair is pound sterling to US dollar, Great British pound versus US dollar. At 9 a.m. the new candle forms. The price opens at 1.2500. For the first 15 minutes, panic sets in. Sellers aggressively dump the pound. The price drops rapidly to 1.2450. On your screen, you would see a solid red bar moving down. It looks terrifying. It looks like a crash. But at 9:30 a.m., something shifts. Maybe a bank in London steps in to buy. Maybe the sellers run out of steam. The price stops falling at 1.2450. This point becomes the low. Slowly, the buyers take control. They push the price back up to 1.2500, the open price. The red body disappears, and for a moment, the candle is just a flat line. This is often called a doji. But the buyers aren't done. They keep pushing. They drive the price up to 1.2550. Now the candle is green. It looks strong. It looks like a rocket taking off. This 1.2550 is the high. However, in the last 5 minutes, traders decide to take their profits. They sell a little bit, and the price dips slightly to close at 1.2540 at 10 a.m. Now look at the finished painting. You have a green body between 1.2500 open and 1.2540 close. You have a small wick on top reaching to 1.2550, and you have a long wick on the bottom reaching down to 1.2450. What does this specific shape tell a professional trader? It tells a story of a turnaround. The long lower wick tells us that the sellers tried to crash the market, but they were completely rejected. The buyers absorbed all that selling pressure and pushed the price higher. This specific shape is often called a hammer or a pin bar. It is a powerful signal that suggests the momentum has shifted from bearish down to bullish up. You aren't just looking at data points. You are reading the psychology of the market participants. You are seeing the fear of the drop being replaced by the greed of the rally. This is the power of Japanese candlesticks. They allow you to X-ray the market. A chart composed of these candles tells you not just where the price is, but how it got there and how much effort it took. A Maribozu candle, for instance, is a candle with a huge body and no wicks at all. If it is a big green candle with no wicks, it means buyers opened the market, bought every single second of the hour, and closed at the very top. There was zero hesitation, zero rejection. That represents pure, unadulterated conviction. If you see that, you know the trend is incredibly strong. On the flip side, a candle with a tiny body and huge wicks on both sides represents indecision. It means the bulls and bears fought a bloody war, pushing price up and down, but eventually ended up right back where they started. This signals confusion in the market. A storm might be coming, but nobody knows which direction it will blow yet. However, looking at one candle in isolation is dangerous. It's like reading one word from a page in a novel and trying to guess the plot. One hammer candle does not guarantee the market will go up. It only suggests a potential reversal. To truly read the road, we need to see how these candles relate to each other. We need to look at the sequence. When you string these candles together, patterns emerge. You start to see the trend. And in Forex, the trend is your only friend. You never want to be the person trying to catch a falling knife. You want to be the person riding the wave. But here is the complexity that confuses beginners. Trends look different depending on your perspective. You can look at a chart and see the price skyrocketing, while your friend looks at the same pair and sees it crashing. How is that possible? It is because you are looking at different time frames. Forex charts are fractal. This means they display the same patterns on different scales. You can view a chart where every candle represents 1 month. You can view a chart where every candle represents 1 minute. On a monthly chart, the euro to US dollar might be in a massive downtrend that has lasted for 2 years. But on a 15-minute chart, the euro to US dollar might be in a beautiful uptrend that has lasted for 3 hours. Who is right? Both of you. The monthly trader sees the macroeconomic collapse. The 15-minute trader sees a brief relief rally within that collapse. This creates a massive problem called analysis paralysis. You check the daily chart, it says buy. You check the hourly chart, it says sell. You check the 5-minute chart, it says buy again. You freeze. You don't know what to do. You make a random guess and you lose money. To solve this, we need to understand the hierarchy of time. We need to understand how the small gears of the minute charts turn the medium gears of the hourly charts, which eventually move the massive gears of the daily and weekly charts. We need to learn multi-time frame analysis. This is the art of zooming out to see the weather and zooming in to find the perfect entry point. But before we can combine timeframes, we must first master the art of identifying the 3 directions a market can move: up, down, and the most dangerous one of all, sideways. Most beginners visualize the market as a coin flip. Heads it goes up, tails it goes down. If that were true, you would have a 50-50 chance of success on every trade. But experienced traders know that the market spends a terrifying amount of time doing neither. It enters a state of paralysis, a zone of indecision that eats amateur accounts alive. This is the sideways market, also known as consolidation or ranging. But to understand why it is so dangerous, we must first master the 2 states where money is actually made: the uptrend and the downtrend. We call an uptrend a bull market. Why a bull? Because when a bull attacks, it thrusts its horns upward into the air. In technical terms, an uptrend is not just price going up. It is a specific structural pattern. It is defined by a series of higher highs and higher lows. Shutterstock. Explore. Imagine you are climbing a mountain. You hike up to a peak, that is the high. You get tired, so you hike down a little bit to a base camp to rest, that is the low. But you don't hike all the way back to the bottom. You stop at a higher elevation than where you started. That is the higher low. Then you start climbing again. You push past your previous peak to a new taller peak. That is a higher high. As long as this structure stays intact, as long as the price keeps making higher highs and higher lows, the trend is bullish. During this phase, the psychology of the market is dominated by greed and optimism. Every time the price dips, the pullback, traders see it as a discount. They rush in to buy, pushing the price back up. This is often called buying the dip. If you are a trend trader, your job is simple. Identify the higher low, buy there, and ride the wave to the next higher high. Conversely, we have the downtrend, or the bear market. A bear attacks by swiping its paws downward. A downtrend is the exact inverse of the uptrend. It is defined by a series of lower highs and lower lows. Imagine a ball bouncing down a set of stairs. It drops to a step lower low, bounces up a little bit but can't reach the height of the previous step lower high, and then drops again to the next step down. In a downtrend, the psychology is fear and pessimism. Every time the price tries to rally, sellers step in, desperate to get out of their positions or to short the market, and they crush the price back down. If you are a trend trader, you are looking for that lower high, the failed rally, to enter a sell position. You want to ride the slide down to the next lower low. Now here is the trap. Most new traders open their charts and desperately hunt for these staircases. They want to see a clean, perfect uptrend or downtrend, but usually they don't find one. Instead, they see a messy, jagged line moving horizontally across the screen. This is the consolidation phase. In a consolidation, the price is trapped. It bounces between a specific upper price limit and a specific lower price limit. It looks like a ping-pong match. It goes up, hits a ceiling, and falls. It goes down, hits a floor, and rises. It fails to make a higher high, and it fails to make a lower low. We call this the meat grinder, because this is where trend traders get slaughtered. Imagine you see the price go up. You think, aha, an uptrend is starting. You buy. But immediately the price hits the ceiling and drops. You panic and sell for a loss. Then you see the price dropping. You think, oh, it must be a downtrend now. You sell. But immediately the price hits the floor and bounces up. You lose again. You are getting chopped up in the noise. Institutional traders, the banks and hedge funds, love consolidation. They use these periods to accumulate massive positions without spooking the market. They quietly buy at the floor and sell at the ceiling over and over again while retail traders panic. To survive these three states, you need to identify the boundaries. You need to draw lines on your chart that tell you where the floor and the ceiling are. In trading, we call these support and resistance. Shutterstock. Explore. Support is the floor. It is a price level where the price has historically had trouble falling below. Think of it as a zone swarming with buyers. Every time the price drops to this level, let's say 1.0500 on euro to US dollar, buyers step in because they perceive the currency as cheap. Their buying pressure acts like a concrete floor, bouncing the price back up. Resistance is the ceiling. It is a price level where the price struggles to break above. It is a zone swarming with sellers. When the price gets too high, sellers step in to take profits, or short sellers enter the market, creating a barrier that pushes the price back down. These levels are not random. They are psychological. They represent price memory. Traders remember that last month, the price stopped at 1.0500, so when it gets there again, they react. The more times a price hits a support or resistance level and bounces away, the stronger and more significant that level becomes. It becomes a psychological fortress. But here is the most critical concept you will learn about market structure. The flip. Imagine a castle with a heavy wooden gate. That gate is resistance. The attackers, the buyers, keep ramming it. First time it holds. Second time it holds. But eventually, if the buyers are strong enough, they smash through the gate. The price breaks resistance and shoots up. Now what happens? The buyers have taken the castle. That same gate that used to keep them out now protects them. The resistance has become support. Shutterstock. Explore. This is called role reversal. When a resistance level is broken, it often turns into support. When the price eventually pulls back down to that old ceiling, it often bounces off it as if it were a new floor. Conversely, when a support level is broken, it often becomes new resistance. This phenomenon happens every single day on every single time frame from the 1-minute chart to the yearly chart. It is the heartbeat of the market structure. Let's apply this to a quick case study. Imagine the price of gold is stuck between $1,900 and $1,950. $1,900 is support. $1,950 is resistance. This is a sideways market. You do nothing. You wait. Suddenly, a war breaks out or inflation data spikes. Investors rush to gold. The price smashes through $1,950 and goes to $1,970. Resistance is broken. Now, the smart trader does not chase the price at $1,970. That is FOMO, fear of missing out. The smart trader waits. They wait for the price to cool off and drop back down to $1,950. Why? Because they want to see if the old ceiling, $1,950, will now act as a floor. If the price touches $1,950 and bounces up, the structure is confirmed. We have a new higher low. The sideways market has officially transformed into an uptrend. That is your sniper entry. Identifying these levels requires a trained eye. You have to look back in time. You have to scroll left on your chart. You will be shocked to see that a random line you draw today lines up perfectly with a peak from 3 years ago. The market never forgets. But drawing lines is subjective. You might draw a line at 1.0500, and I might draw it at 1.0510. Who is right? And more importantly, how do we know if a support level is actually going to hold? What if we buy at support thinking it's a floor, but the price smashes right through it like it's made of paper? That is called a breakout, and if you are on the wrong side of it, it is catastrophic. We need a way to filter our decisions. We need objective mathematical confirmation that the trend is real, or that the momentum is shifting. We cannot rely solely on our eyes, because our eyes can play tricks on us. We need tools that crunch the numbers for us. We need to open the toolbox of technical indicators. Specifically, we need to discuss the most popular tool in the history of financial markets. A tool that smooths out the chaos and draws a single elegant line through the noise. It is the primary weapon used by algorithms to determine the trend. In the next part, we are going to master the moving average, and we will show you how the golden cross and the death cross can predict massive market shifts weeks before they happen. Imagine you are driving a car down a winding mountain road in the middle of a torrential rainstorm. The rain is pounding against the windshield, the fog is thick, and visibility is near zero. You can barely see 3 feet in front of you. The white lines on the road are obscured. Every pothole feels like a crater. Every gust of wind feels like it's pushing you off a cliff. This is exactly what a raw price chart looks like to a beginner. The noise of individual candles, the erratic spikes up and down caused by momentary panic or news releases, is the rain. It blinds you to the actual direction of the road. To survive this drive, you don't need to see every single raindrop. You need a GPS line that cuts through the storm and shows you the general curve of the highway. In trading, that GPS is the moving average. The moving average is the grandfather of technical indicators. It is elegant in its simplicity but profound in its utility. It takes the chaotic data of the past, the closing prices of the last X number of candles, and averages them out to create a single smooth flowing line. It filters out the noise and leaves you with the pure trend. Shutterstock. Let's start with the most basic version. The simple moving average, or SMA. Imagine you want to calculate the 20-period SMA on a daily chart. You take the closing price of the last 20 days, add them all together, and divide by 20. That gives you a single price point. The next day you drop the oldest data point, add the new one, and recalculate. When you connect these dots, you get a line that trails behind the price action. If the price is above this line, the trend is generally up. If the price is below this line, the trend is generally down. It sounds too simple to be effective, right? Wrong. The 200-day simple moving average is widely considered the line in the sand for the entire global economy. It is watched by everyone from retail traders in their basements to central bankers in Switzerland. Why? Because it represents the average price of the last trading year. Here is a case study in institutional psychology. When the price of a major asset like the S&P 500 or the euro to US dollar pair approaches the 200-day SMA from above, hedge funds and pension funds pay attention. If the price touches that line and bounces, it confirms that the long-term bull market is still healthy. Algorithms are programmed to buy at this line. It becomes a self-fulfilling prophecy. Because everyone expects the 200 SMA to act as support, they buy when it gets there, which causes the price to bounce. However, the simple moving average has a flaw. It is slow. It is lazy. Because it treats the price from 200 days ago with the exact same importance as the price from yesterday, it takes a long time to react to sudden market crashes or rallies. By the time the SMA turns down, the market might have already crashed 20%. Enter the exponential moving average, or EMA. The EMA is the sports car to the SMA's city bus. The math behind the EMA is weighted. It gives significantly more importance to recent price action than to older data. It understands that what happened yesterday is more relevant to today's price than what happened 3 months ago. Because of this weighting, the EMA hugs the price action tighter. It turns faster. If the market spikes, the EMA spikes with it. For short-term traders like day traders or swing traders, the EMA is often the preferred weapon because it provides earlier signals. Now, let's look at how we actually use these lines to make money. We don't just watch them. We use them as dynamic support and resistance. Remember in the last video we drew horizontal lines for support and resistance? Those are static. They stay at one price level, but the market is fluid. During a strong uptrend, the price might never drop all the way back down to a horizontal support level. Instead, it will pull back, tap the 50-period EMA, and launch higher. Imagine a ball floating down a river. The river is the moving average. The ball, the price, might bob up and down, moving away from the center of the current and then drifting back, but the current, the EMA, keeps pushing it in one direction. A common strategy is to wait for the price to pull back and touch the moving average. When it touches, you look for a candlestick pattern like that hammer we discussed to confirm the bounce. That is your entry signal. You are buying value within a trend. But the most famous application of moving averages involves using two of them at the same time to predict massive macroeconomic shifts. This is where we get the golden cross and the death cross. To see this, you place a fast-moving average, usually the 50-day SMA, and a slow-moving average, usually the 200-day SMA, on the same chart. The golden cross occurs when the faster 50-day line crosses above the slower 200-day line. Visualize what this means mathematically. It means that the average price of the last 2 months is now higher than the average price of the last year. Short-term momentum has overpowered long-term sentiment. This is a screaming buy signal for long-term investors. Historically, golden crosses in the stock market and major Forex pairs have often preceded multi-year bull runs. Conversely, the death cross occurs when the 50-day line crosses below the 200-day line. This indicates that short-term sentiment is collapsing relative to the long-term trend. It signals a potential bear market or a recession. When the news headlines scream about a death cross in the markets, it usually triggers a wave of selling as fearful investors exit their positions. However, before you rush to open your trading platform and bet your life savings on the next crossover, we must address the elephant in the room. The fatal flaw of all moving averages. They are lagging indicators. They do not predict the future. They report the past. They are a rearview mirror, not a crystal ball. Because they are based on past data, they will always be late to the party. By the time a golden cross actually prints on the chart, the price might have already risen significantly from the bottom. You missed the first leg of the move. Worse, in a sideways or ranging market, that meat grinder we warned you about, moving averages become useless. When the price is chopping up and down, the moving averages will cross over each other repeatedly back and forth, giving you false signals. We call this a whipsaw. You get a buy signal golden cross, so you buy. The market immediately drops. You get a sell signal death cross, so you sell. The market immediately rallies. You get whipped back and forth until your account is empty. This is why you can never ever rely on a moving average alone. It is a confirmation tool, not a trigger. It tells you the direction of the wind, but it doesn't tell you when to open the sail. So we have a dilemma. We have price action, candlesticks, which is immediate but chaotic. We have trend indicators, moving averages, which are smooth but slow. We need something else. We need a way to measure the energy of the market. Imagine a rubber band. If you stretch it, it extends. If you stretch it further, the tension builds. Eventually, you reach a point where the rubber band cannot stretch any further. It is exhausted. It must snap back. The market works the same way. Prices cannot go up in a straight line forever. Buyers eventually run out of cash. The rubber band gets overstretched. We call this being overbought. Conversely, when panic selling occurs, the price can only drop so far before sellers are exhausted. We call this being oversold. How do we identify these invisible turning points? How do we know when the market is about to snap back before the moving average even turns? We need a specific type of tool called an oscillator. And the king of oscillators is a tool developed by a mechanical engineer in the 1970s that measures the velocity and magnitude of price movements. It is called the RSI, or the Relative Strength Index. In the next section, we are going to install this speedometer on your dashboard. We will teach you how to spot divergence, one of the most powerful reversal signals in existence, where the indicator secretly tells you the truth while the price is lying to everyone else. If the moving average is your GPS telling you the direction of the road, then the Relative Strength Index, or RSI, is your speedometer and fuel gauge rolled into one. J. Wells Wilder Jr., the mechanical engineer who designed this tool in 1978, understood that price movement is merely the result of momentum. He knew that a car speeding at 100 miles per hour cannot turn a sharp corner without slowing down first. If it tries, it crashes. The market operates on the exact same law of physics. When you load the RSI onto your chart, it doesn't appear on the main screen with the candlesticks. It opens in a separate window at the bottom, known as the oscillator window. It consists of a single line moving between a scale of 0 to 100. To the uneducated trader, this squiggly line looks like just another distraction. To the professional, it is a direct readout of the market's heartbeat. The standard settings give you two critical zones: the 70 line and the 30 line. The area above 70 is the overbought zone. The area below 30 is the oversold zone. Here is the basic theory that traps millions of beginners. The theory states that when the RSI line crosses above 70, the market is overheated. Buyers have exhausted their capital, the price has risen too far too fast, and a reversal is imminent. Therefore, the textbook says you should sell. Conversely, when the RSI crosses below 30, the market is oversold. Sellers are exhausted, the price is too cheap, and you should buy. If you follow this advice blindly, you will lose your entire account. Let's run a simulation to prove why. Imagine a massive geopolitical event occurs, say, the United States announces a surprise economic boom. The US dollar skyrockets. The chart goes vertical. Big green candles are printing one after another. The RSI shoots up past 70. You think, it's overbought. It has to come down. So you sell. But the trend is so strong that the RSI stays above 70. It hovers at 75, then 80, then 82. Meanwhile, the price keeps climbing higher and higher. You are adding to your losing sell position, screaming at the screen that the indicator is broken. It isn't broken. In a strong trending market, the RSI can remain overbought for days, or even weeks. The speedometer is pinned at the maximum, and the car just keeps accelerating. This is why trading solely on overbought and oversold signals is a death sentence. So how do the pros use it? We use it to find divergence. Shutterstock. Explore. Divergence is the anomaly. It is a glitch in the matrix where the price tells you one story, but the momentum tells you the truth. It occurs when the price action and the RSI indicator disagree with each other. Let's construct a detailed case study of bearish divergence. Imagine you are watching the US dollar to Japanese yen pair. The trend is up. The price hits a high of 145.00. The RSI hits a high of 75. Everything is normal. The price pulls back slightly to 144.50, then rallies again. The buyers push hard, and the price breaks the old high, reaching a new peak of 146.00. On the price chart, this is a higher high. It looks like a breakout. It looks bullish. The crowd is cheering and buying, thinking the trend is resuming. But now you look down at the RSI. When the price hit 145.00, the RSI was at 75. Now that the price is at 146.00, you expect the RSI to be higher, perhaps at 80. But it isn't. The RSI has only rallied to 65. Look closely at that discrepancy. Price made a higher high, 146.00 versus 145.00. RSI made a lower high, 65 versus 75. What does this mean? It means that while the car is moving faster, the driver has taken their foot off the gas. The new high in price was created with less momentum and less participation than the previous high. It is a fake out. It is a weak rally disguised as a strong one. The buyers are running on fumes. This is bearish divergence. It is one of the most reliable reversal signals in technical analysis. When you see this, you do not buy the breakout. You prepare to sell the collapse. Now let's flip it for bullish divergence. Imagine the euro to US dollar is crashing. Price drops to 1.0500. RSI drops to 25, oversold. Price bounces slightly, then crashes again to a new low of 1.0400. Panic is everywhere. The news is screaming that the euro is dead. Everyone is selling, but you look at the RSI. At the new lower price of 1.0400, the RSI has not dropped to 20. Instead, it has risen to 35. Price made a lower low. RSI made a higher low. The sellers are pushing price down, but the intensity of the selling is fading. The bears are losing their grip. This is the sign that the smart money is quietly accumulating long positions, while the retail crowd is panic selling at the bottom. Divergence acts as your early warning system. It allows you to enter a reversal before the trend officially changes on the moving averages. You are getting in at the turning point. However, even with candlesticks support and resistance, moving averages and RSI divergence, we are still missing half the picture. Everything we have discussed so far falls under the umbrella of technical analysis. We have been studying the effect. The chart is just a visual representation of the effect of buying and selling. But what is the cause? Why did the price move in the first place? Why did the euro to US dollar drop 100 pips at 8:30 a.m. on a Friday? Why did the Japanese yen crash when the Bank of Japan governor spoke? Technical analysis tells you when to enter. Fundamental analysis tells you what to trade and why. If you ignore fundamental analysis, you are like a surfer trying to catch waves without knowing about the tides or the wind. You might get lucky and catch a few, but eventually a rogue wave you didn't see coming will drown you. In the world of Forex, these rogue waves are scheduled events. They are news releases. And the biggest shark in the ocean, the entity that creates the biggest waves, is the central bank. Every major currency is managed by a central bank. The US dollar has the Federal Reserve, the Fed. The euro has the European Central Bank, ECB. The pound has the Bank of England, BOE. These institutions have one primary superpower. They control interest rates. Interest rates are to Forex what gravity is to physics. They are the strongest force in the market. Here is the simple economic logic you must burn into your brain. Money flows to where it gets the highest return. Imagine you are a billionaire hedge fund manager. You have $10 billion in cash. You want to park that money in government bonds to earn a safe, risk-free interest payment. Country A offers you an interest rate of 1% per year. Country B offers you an interest rate of 5% per year. Where do you put your money? You put it in Country B. You want that 5% yield. But to invest in Country B, you have to convert your $10 billion into Country B's currency. You have to sell your currency and buy theirs. When millions of investors do this simultaneously, the demand for Country B's currency explodes. The value of that currency skyrockets. This is why Forex traders are obsessed with interest rates. We are constantly watching the central banks to see if they are going to raise rates or lower rates. If the Federal Reserve hints that they are going to raise interest rates in the United States, traders will instantly buy the US dollar in anticipation. They want to front-run the flow of global capital. If they hint that they are going to cut rates, traders will sell the US dollar, because investors will move their money elsewhere to find better yield. But the central banks don't just wake up and decide to change rates based on a coin flip. They make their decisions based on data. They look at the health of the economy. Is the economy growing? Is inflation too high? Are people employed? This brings us to the most dangerous and profitable document in the world, the economic calendar. Every single day, governments release data points about their economies. Most of them are noise, but a few of them are nuclear bombs. There is one specific monthly report released by the United States government that is so powerful it can move the market more in 5 seconds than it usually moves in 5 days. It is the Super Bowl of trading. It destroys more accounts than any other event, but for the prepared, it offers the opportunity of a lifetime. It happens on the first Friday of every month, and if you don't know what it is, you shouldn't be touching a live account. In the next video, we are going to walk you through the chaos of the NFP. NFP, non-farm payrolls. It is 8:29 a.m. Eastern Standard Time on the first Friday of the month. In London, it is afternoon. In Tokyo, it is late evening. But all around the world, tens of millions of traders are staring at their screens in absolute silence. The chat rooms go quiet. The price of the euro to US dollar pair, which usually moves constantly, suddenly freezes. The liquidity dries up as the big banks pull their orders, refusing to be caught on the wrong side of what is about to happen. It feels like the ocean receding before a tsunami. Then the clock hits 8:30 a.m. A single number hits the newswires. Chaos erupts. In less than 1 second, algorithms from high-frequency trading firms in Chicago and New York slam billions of dollars into the market. The chart doesn't just move. It teleports. The price might jump 50 pips up, crash 70 pips down, and then rally 100 pips all within 60 seconds. If you are a beginner trying to trade this with high leverage, you don't just lose money. Your account balance can actually go negative. You can owe the broker money. This is the power of the United States employment data. But what exactly is this number? The non-farm payroll report measures the number of added or lost jobs in the U.S. economy over the previous month, excluding farm workers, private household employees, and non-profit organization employees. We exclude farmers because agriculture is too seasonal. It relies on weather and harvest cycles that distort the true picture of economic health. Why does this number rule the world? Because the logic chain of the economy starts with a job. If businesses are hiring, it means they are confident. If people have jobs, they receive a paycheck. If they have a paycheck, they spend money on iPhones, cars, and dinners. This spending drives corporate profits and, crucially, creates inflation. If inflation rises, the Federal Reserve, the boss of the US dollar, must raise interest rates to cool things down. And as we learned in the last section, higher interest rates make the currency stronger. So the equation is simple. Strong NFP number, more jobs than expected, equals strong US economy, equals higher interest rates, equals US dollar goes up. Weak NFP number, fewer jobs than expected, equals weak US economy, equals lower interest rates, equals US dollar goes down. However, trading this event is not as simple as see good number by dollar. You have to understand the concept of the forecast versus the deviation. Wall Street is an anticipation machine. Weeks before the NFP is released, economists from major banks like Goldman Sachs and Morgan Stanley publish their predictions. They might say, "We expect the U.S. economy added 200,000 jobs this month." This number, 200,000, is the consensus forecast. Here is the secret. The market has already traded based on this number. The price you see on the chart at 8:29 a.m. already includes the expectation of 200,000 jobs. It is priced in. If the actual number comes out at 205,000, the market might not move at all. It's exactly what everyone expected. The news is a dud. But imagine the actual number comes out at 350,000. This is a massive beat. This is a huge deviation. The market is shocked. It realizes it has miscalculated the value of the dollar. It has to reprice the entire currency instantly. This creates a violent repricing event. The further the actual number is from the forecast, the more violent the move. This brings us to a terrifying phenomenon called slippage. This is why beginners get slaughtered during NFP. Imagine the euro to US dollar is at 1.1000. You see the news is good for the dollar, so you hit sell on the euro. You want to enter at 1.1000, but because the price is moving so fast, literally jumping over price levels, there is no one to take the other side of your trade at 1.1000. The next available buyer is at 1.0950. Your broker fills your order at 1.0950. You have instantly slipped 50 pips. You are entering the trade 50 pips worse than you planned. If the market reverses, you are immediately deep in the red. During major news events, the spread, the cost to open a trade, can widen from 1 pip to 20 pips. Case studies suggest that the safest way for a beginner to handle the NFP is to be flat. Have no open positions. Watch the fireworks. Let the amateurs get slaughtered in the initial volatility. Wait 15 to 30 minutes for the dust to settle and the true direction to reveal itself. Then use your technical analysis to enter. But NFP is not the only giant on the calendar. You must also respect the CPI, the Consumer Price Index. Shutterstock. While NFP measures jobs, CPI measures inflation. It tracks the price of a basket of goods: milk, gas, rent, used cars. In the post-2020 economic era, CPI has arguably become even more important than NFP. When inflation in the US hit 9% in 2022, the CPI releases were causing market crashes that wiped out trillions of dollars in global equity value. The logic is the same. High CPI, high inflation, forces the Fed to be aggressive. They must raise rates to stop you from spending money. Higher rates equal a stronger currency. Low CPI, low inflation, allows the Fed to relax. They can cut rates. The currency weakens. So, how do we combine this fundamental analysis with the technical analysis? Candlesticks, patterns, indicators. We learned in parts 1 through 7? This is the holy grail of trading. Technicals give you the entry. Fundamentals give you the direction. Imagine you are looking at the US dollar to Japanese yen chart. Technically, you see a golden cross. Bullish. You see the price bouncing off a support level. Bullish. You see RSI divergence. Bullish. Every technical signal is screaming buy. But then you look at the fundamental picture. You see that the US economy is crashing, inflation is dropping to zero, and the Fed is about to cut interest rates. The fundamental bias is bearish. What do? You do nothing. You do not buy. Why? Because you are trying to swim upstream. You are trying to use a chart pattern to fight a central bank. The chart pattern might work for a few hours, but eventually the macroeconomic reality will crush it. The best trades, the ones that make careers, happen when the technicals and the fundamentals align. When the US economy is booming, fundamental buy, and the chart shows a bullish breakout, technical buy, that is when you strike. That is when the wind is at your back. This approach filters out bad trades. It stops you from shorting a strong currency just because the RSI is overbought. It stops you from buying a weak currency just because it hits support. Support will break if the economic data is bad enough. There is one final fundamental concept you must grasp. Sentiment. Sentiment is the mood of the market. It is risk-on versus risk-off. In a risk-on environment, investors feel safe. The global economy is growing. They sell safe assets like the US dollar and the Japanese yen, and they buy risky assets like the Australian dollar, the British pound, and stocks. In a risk-off environment, investors are terrified. Maybe there is a war, a pandemic, or a banking collapse. They dump risky assets and flee to safety. They buy the US dollar, the Japanese yen, and gold. Identifying whether the world is in risk-on or risk-off mode will tell you which currency pairs are likely to move. At this point in our masterclass, you are becoming dangerous. You know the players, banks versus retail. You know the vehicle, pairs, leverage, margin. You know the map, support, resistance, trends. You know the signals, candlesticks, RSI, moving averages. And now you know the weather fundamentals, NFP, CPI. You have a complete trading system. You can analyze the market, pick a direction, and find an entry. You are ready to trade, right? Wrong. If you start trading now with real money, you have a 100% probability of eventually blowing up your account. Not because your analysis is wrong. You could be the best analyst in the world. You could predict the next move of the euro with 90% accuracy. But that 10% of the time you are wrong, it will wipe out all 90% of your wins and take your original capital with it. Why? Because you are missing the mathematical safety net. You are missing the seatbelt, the airbag, and the brakes. You are missing the concept of risk management. Most people think trading is about predicting the future. It isn't. It is about managing probability. In the next video, I am going to show you the mathematical formula that allows a professional trader to lose 60% of their trades, literally being wrong more often than they are right, and still end the year with a massive profit. We are going to learn about risk-to-reward ratios, position sizing, and the psychological discipline required to cut a losing trade before it destroys you. This next part is the boring part, but it is the only part that will keep you in the game. Welcome to the most critical room in the entire financial building. We have left the noisy trading floor where people shout about interest rates and chart patterns. We have stepped into the quiet, air-conditioned office of the risk manager. This is where the boring work happens, and it is exactly why this is the only room where long-term careers are actually built. You can have the best strategy in the world, you can predict the NFP number down to the exact digit, but if you do not master the mathematics of survival, the market will eventually bankrupt you. It is not a question of if, it is a mathematical certainty. Let's start with a controversial statement that contradicts everything your intuition tells you. You do not need to be right to make money. In fact, you can be wrong the majority of the time. You can lose more trades than you win, and still make a fortune. How is this possible? It comes down to a single, non-negotiable formula called the risk-to-reward ratio. Imagine two traders. Let's call them Trader Alpha and Trader Beta. Trader Alpha is obsessed with being right. He wants that dopamine hit of seeing a green win on his screen. He designs a strategy that wins 90% of the time. He is a sniper. But to achieve this 90% win rate, he takes tiny profits. He scalps the market for 5 pips at a time. However, when he loses, he refuses to accept defeat. He holds onto the losing trade, hoping it will turn around. He risks 50 pips to make 5 pips. Let's do the math on 10 trades. He wins 9 trades. 9 times 5 pips equals 45 pips of profit. He loses 1 trade. 1 times 50 pips equals 50 pips of loss. Net result, minus 5 pips. He was right 90% of the time and he still lost money. This is the trap of the high win rate fallacy. Shutterstock. Now look at trader beta. She doesn't care about being right. She cares about expectancy. She is a trend follower. She knows markets are messy. She expects to lose often. Her strategy only wins 40% of the time. She is wrong 6 times out of 10. But she understands risk to reward. She never enters a trade unless the potential profit is at least 3 times larger than the potential loss. This is a 1-to-3 ratio. She risks 20 pips to make 60 pips. Let's do the math on her 10 trades. She loses 6 trades. 6 times 20 pips equals 120 pips of loss. She wins 4 trades. 4 times 60 pips equals 240 pips of profit. Net result, plus 120 pips. She failed more than she succeeded. She was wrong most of the time. Yet, she is the one booking a flight to the Maldives while Trader Alpha is blowing up his account. This is the holy grail. Professional trading is not about prediction. It is about asymmetry. It is about finding setups where the upside is significantly larger than the downside. If you consistently take trades with a 1-to-1 ratio, risking $1 to make $1, you are fighting a 50-50 coin flip, and the broker's spread will slowly bleed you to death. You must tilt the math in your favor. But knowing the ratio is only the first step. The second step is determining exactly how much money to put on the table. This is called position sizing, and it is the most commonly violated rule by beginners. Most beginners determine their position size based on their ego. They deposit $1,000. They think, I want to make $500 today. So they open a standard lot, 1.00, where every pip is worth $10. If the market moves 50 pips against them, which can happen in a heartbeat, they lose $500. They just lost 50% of their account in one trade. This is not trading, this is gambling. Professional traders adhere to the 1% rule. This rule states that you never, under any circumstances, risk more than 1% of your total account equity on a single trade concept. If you have a $10,000 account, your maximum risk is $100. If you have a $1,000 account, your maximum risk is $10. It sounds painfully slow. You might be thinking, I'm not going to get rich making $20 profit on a trade. And you are right. You aren't going to get rich quickly, but you aren't going to go broke quickly either. The 1% rule ensures that you can survive a losing streak of 20 trades in a row and still have more than 80% of your capital left to fight another day. So how do we calculate the lot size? You cannot just guess. You have to use a formula. Step 1. Determine where your stop loss needs to be based on the chart structure, not your wallet. Let's say you are buying at support, and the support level is 20 pips away. Step 2. Determine your monetary risk. $10,000 account x 1% equals $100. Step 3. Divide the money by the distance. $100 divided by 20 pips equals $5 per pip. You need a position size that pays $5 per pip. Step 4. Translate to lots. Standard lot equals $10 per pip. Mini lot equals $1 per pip. You need 5 mini lots, 0.50 lots. If the stop loss was 50 pips away, the math changes. $100 divided by 50 pips equals $2 per pip. You would trade 0.20 lots. Notice what happened. The wider your stop loss, the smaller your position size must be. This is dynamic risk management. You are adjusting your bet size to fit the volatility of the market. This leads us to the tool that executes this plan, the stop loss order. A stop loss is an automatic order that tells the broker, if the price reaches this level, get me out immediately. I accept the loss. It is your oxygen tank. It is your parachute. Imagine this scenario. It is 2015. The Swiss National Bank unexpectedly unpegs the franc from the euro. The market crashes 2,000 pips in minutes. Traders who did not have a stop loss in place didn't just lose their account balance. The drop was so fast that their accounts went into negative equity. They received legal letters from their brokers demanding payment for tens of thousands of dollars they didn't have. Traders who had a stop loss took a hit. They lost their 1%. They were annoyed, but they were safe. Never enter a trade without a stop loss. But here is the psychological demon that will whisper in your ear. You will place your stop loss. The price will move toward it. You will see you are about to lose $100. The demon will say, just move the stop loss a little further down. Give it room to breathe. It will turn around. So you move it. The price keeps dropping. Just a little more, the demon says. It has to bounce at the next support level. You move it again. Suddenly, your $100 loss has turned into a $500 loss. You are paralyzed. You can't close it now. The loss is too big to accept. You pray. You bargain with the market. Eventually, the broker margin calls you. The trade is closed. You have lost 50% of your account because you refused to take a 1% loss. This behavior stems from a fundamental misunderstanding of what a loss is. To a professional, a loss is not a failure. It is an operating expense. Think of a retail store like Walmart. They have to pay for electricity, rent, and employee salaries. These are costs of doing business. They don't cry when they pay the electric bill. In trading, losing trades are your electric bill. They are the cost of doing business in the market. You pay the loss to buy the information that this trade setup didn't work. You pay it and you move on. There is an old saying on Wall Street: cut your losers short and let your winners run. Most beginners do the exact opposite. They cut their winners short because they are terrified the profit will disappear, and they let their losers run because they are terrified of realizing the loss. You must rewire your brain. You must become a machine that executes the plan without emotion. Now we have built the entire car. We have the engine, fundamental analysis, the wheels, technical analysis, the fuel, capital, and the brakes, risk management. You know how to drive. But knowing how to drive and actually navigating a cross-country road trip are two different things. You can have all the knowledge in the world, but if you don't have a map and a schedule, you will get lost. You need a trading plan. You need a rigid set of rules that dictates exactly when you wake up, what you look for, how you journal your trades, and how you review your performance. You need to transition from a hobbyist who plays the market to a CEO who runs a trading business. In the final video of this masterclass, we are going to bring everything together. I am going to give you a template for a professional trading plan. We will discuss the psychology of discipline, how to control the fear and greed that will inevitably arise. And I will give you the roadmap for your first 90 days. Exactly what to do week by week to go from this video series to placing your first live trade safely. The journey is almost complete. Let's finish strong. Imagine you are the CEO of a startup. You wouldn't walk into your office, throw a pile of cash on the table, and randomly guess which product to launch that day based on how you feel. If you did that, your investors would fire you and your company would be bankrupt by lunchtime. Yet, this is exactly how 99% of beginners approach Forex. They open their laptops, look at a chart, feel a hunch, and press a button. They are not running a business. They are visiting a casino. To graduate from this masterclass, you must draft your constitution. You need a trading plan. A trading plan is a physical document, printed out and taped to your wall, that removes your brain from the equation. When the market is moving fast, your brain will be flooded with cortisol and adrenaline. You will be incapable of making rational decisions. Your trading plan makes the decisions for you. It is your pre-flight checklist. A pilot does not take off just because the sky looks blue. They check the fuel, the flaps, the hydraulics, and the weather report. If one item fails the check, the plane stays on the ground. Your plan must consist of 5 non-negotiable pillars. First, the when. You will not trade 24 hours a day. You will define a specific window. For example, I will only trade the New York session overlap from 8 a.m. to 11 a.m. Eastern Standard Time. If a setup happens at 3 p.m., you do not take it. You are off the clock. Second, the what. You will not trade every pair. You will specialize. I will only trade euro to US dollar and pound sterling to US dollar. If gold is skyrocketing, you do not chase it. You stick to your domain. Third, the risk. I will never risk more than 1% of my account on a single trade, and I will never have more than 2 trades open at once. Fourth, the setup. This is your if-then logic. If price hits a 4-hour support level, and the RSI shows bullish divergence, and a hammer candle forms on the 1-hour chart, then I will enter a buy. If you have the support and the divergence but no hammer candle, you do not click the button. Fifth, the exit. You must know where you are getting out before you get in. I will exit if the price hits my take profit level of 1:3 risk to reward, or if the structure breaks against me. If you follow this plan, you are no longer gambling. You are executing a statistical edge. But even with the plan, there is one enemy that can still destroy you: the revenge trade. Case studies suggest that the majority of trading accounts are not blown over a period of months. They are blown in a single afternoon of madness. Imagine you follow your plan perfectly. You take a trade. It hits your stop loss. You lose 1%. You feel a sting of pain. Your ego is bruised. You think, I was right. The market just stopped me out to be mean. You immediately see another candle moving. You think, I can get that 1% back right now if I just double my position size. You enter a trade without a setup. You ignore your plan. Goes against you. Now you are down 3%. Panic sets in. The logic center of your brain shuts down. The fight or flight response takes over. You scream, I just need to get back to break even. You go all in. The market moves 10 pips against you. Margin call. Game over. This is the psychology of destruction. To prevent this, you must implement a circuit breaker rule. For example, if I lose 2 trades in a row, I am banned from trading for 24 hours. You must physically walk away from the computer. The market will be there tomorrow. Your money won't be if you stay. Now, how do you improve? How do you know if your plan actually works? You need a black box flight recorder. You need a trading journal. You must record every single trade in a spreadsheet. Not just the profit or loss, but the emotional context. Date: October 12th. Pair: Euro to US dollar. Result: minus $50. Notes: I entered too early because I was bored. I didn't wait for the candle to close. After 1 month, you will look at your journal and realize a pattern. You might see that 80% of your losses happen on Mondays, or that 90% of your wins come from shorting the US dollar to Japanese yen. Data reveals the truth. Once you know that you lose money on Mondays, you simply stop trading on Mondays. You have instantly improved your profitability by removing the negative outliers. So you have the knowledge. You have the plan. You have the journal. What do you do when this video ends? Do you deposit your life savings? Absolutely not. Here is your 90-day roadmap to professionalism. Phase 1: the sponge, days 1 to 30. For the first month, you do not place a trade. Not even on a demo account. You simply watch. You open the charts every day at the same time. You draw your support and resistance lines. You watch how the price reacts to news events like the NFP. You practice identifying higher highs and lower lows. You are training your reticular activating system to spot patterns in real time. You are learning the rhythm of the ocean before you get in the boat. Phase 2: the scientist, days 31 to 60. Now you start backtesting. This is the unglamorous work that separates the pros from the dreamers. You use a charting platform to scroll back in time to a random date, say 2 years ago. You hit the replay button. You watch the candles form one by one. You execute your trading plan on this historical data. You do this hundreds of times. You record the results. After 100 backtested trades, you look at the data. Did the strategy make money? What was the maximum drawdown? What was the win rate? If the strategy lost money in the past, it will lose money in the future. You tweak the plan and test again. You do not move forward until you have a mathematically proven edge on historical data. Phase 3: the simulator, days 61 to 90. You open a demo account. This uses fake money but live market data. You treat this account exactly like it is real money. If you plan to start with $1,000 of real money eventually, do not open a $100,000 demo account. Open a $1,000 demo account. Be realistic. Trade your plan live. Feel the emotions of waiting for a setup. Feel the frustration of missing a trade. Your goal here is not to make $1 million. It is to execute your plan without error for 30 consecutive days. If you break a rule, if you take a revenge trade or risk too much, you restart the clock. You do not graduate Phase 3 until you have flawless discipline. Phase 4: the live launch, day 91. You deposit real funds. But you do not start with your full capital. You start with the minimum required to open a micro-lot position. Why? Because the moment real money is on the line, your psychology will change. Losing $10 of real money hurts more than losing $10,000 of monopoly money. You need to acclimate to the pressure. You are now a live trader. You are swimming in the river. We have covered a massive amount of ground. We started by staring at the $6.6 trillion river of capital. We learned the language of pairs, pips, and lots. We dissected the battle between bulls and bears using candlesticks. We map the battlefield with support and resistance. We track the trend with moving averages and momentum with the RSI. We learn to respect the tidal waves of the central banks and the NFP. We built the safety net of risk management, and we designed the flight plan for your career. The foreign exchange market is the purest form of capitalism on earth. It is a meritocracy. The market does not care about your gender, your race, your religion, or your social status. It does not care if you need money for rent or for a Lamborghini. It is a cold, unfeeling mirror that reflects your own discipline and patience back at you. If you treat this like a get-rich-quick scheme, the market will take everything you have. It will punish your greed and exploit your fear. But if you treat this with the respect of a surgeon or an engineer, if you study the data, manage the risk, and master your own mind, it offers a potential for freedom that exists in almost no other profession. It offers you the ability to extract value from the flow of the global economy, from anywhere in the world, with nothing but a laptop and a Wi-Fi connection. The 90-90-90 rule says you will fail. But you are no longer part of the herd. You are informed. You are prepared. You have the map. The sharks are still in the water, and the current is still strong, but for the first time you know how to swim. The journey of 1,000 miles begins with a single step, but the journey of a profitable trader begins with a single plan. Close this video, open your journal, write your plan, and welcome to the market.